Hey there, welcome to this edition of Behind the Charts. We sat down not too long ago with Sam Stovall. Sam is the Chief Investment Strategist at CFRA. He's based in the New York area. He was with S&P and other groups before then. Sam is a market strategist. He is not a technical analyst. And I've always enjoyed talking with people who are not technical analysts but incorporate charts into their thinking. If you go on StockCharts.com, you're going to see some of Sam's work actually highlighted. He created the sector rotation map that we feature on our chart school and that we use to illustrate how sectors lead and lag in different parts of the economic and business cycle. So it was great sitting down with Sam talking about sector rotation, talking about market cycles, and how he relates the technicals to other things. As he put it, fundamentals tell you what, technicals tell you when and how far, which I thought was really well said. He also talked about starting with history. The best part about technical analysis and charts is they show you market history, then you look at the fundamentals and see how they relate to that historical lens. So here's my conversation with Sam Stovall from CFRA. So we're here with Sam Stovall, Chief Investment Strategist at CFRA Research here in New York. Sam, thanks so much for joining us.
Happy to be
Appreciate
here,
it. You know, I have to start off, I've known you for a number of years, not super well, but you probably don't remember this, but I first met you years ago, and it's when I was talking with Ralph Akampora, and you came up and started talking with Ralph, and it was early on in my career, and what struck me was how you and Ralph greeted each other as old friends, as old buddies. Just to start off, can you talk about the camaraderie, not just with someone like Ralph, but with others in the industry? How has that been a part of your experience in the financial industry?
Well, first off, I hope I said excuse me.
You were very cordial, actually.
Right.
Yeah.
Good.
Yeah.
Well, a combination of things.
Yeah.
First off, my father had been in the business since 1953.
Wow.
His first job was working for the guy who wrote The Battle for Investment Survival.
Oh, no kidding.
At EF
Loeb, right?
Yeah.
Right.
Gerald Loeb.
Yeah.
And so, you know, when you get to have the opportunity to meet people like that,
Yeah.
I was the program chair for the American Association of Individual Investors here in New York City for 8 years.
Okay.
And so had the opportunity to invite a lot of guests, again, leveraging my father's contacts. But
Right.
what I found amazingly was that everybody was very willing to do it. Even though their client base might be more institutional in nature,
Right.
they were always very willing to do retail audiences.
Right.
And I remember asking Bob Hormats, the former vice chairman of Goldman Sachs, I said, do you have any retail clients? And he said, no. And I said, well, then why did you come to do this? And he said, because you asked. And
Isn't that great?
I will never forget that. I mean, that was wonderful. So yes, I think it's because I appreciate all that they have done for me.
Yes.
And at the same time, I get to benefit by learning from them.
That's fantastic. So Sam, for those that are not familiar with your work and your background, can you just give us a quick breakdown of how you got to where you're at now? Particularly, and I know you're a strategist, but I always think of you as a chart-friendly strategist. You're someone who incorporates a lot of visuals. How did that piece of it, the more technical, the more price-oriented, chart-oriented piece, fit into your process?
Well, I think in many ways it's because I'm visual by nature.
Okay.
Also, I went to NYU and got an MBA in finance.
Got it.
But my favorite course was with Rolf Wubbles, and it was a class on technical analysis.
Interesting.
And I loved it. My philosophy is that fundamentals tell you what, but technicals tell you when and how far.
There you go.
And I like to compliment Ralph by saying, and Ralph will tell you how to do it.
Yeah.
But basically, no, I think it's very important because sometimes the fundamentals can look very, very good for a very long time.
Yeah.
I mean, international is probably an exceptional example right now in terms of a relative price performance. It's more than a standard deviation below the mean of the S&P 500. Ditto for valuations. But it's, that's an area to move into only when the charts tell you that the relative strength is starting to improve.
Right.
So I would say that I try to combine stock market fundamentals with technicals and with history. I went to Muhlenberg College for undergraduate.
Right.
My degree was in history. And so in many ways, I'm a big believer in what Mark Twain said, where history might not repeat, but it frequently rhymes.
Sure.
But I like to add that, like the singer of the national anthem, sometimes it forgets the words. So my thought is, okay, you can start with history. That's a very good guide, but it's not gospel.
Yeah.
And then you overlay the fundamentals, and then to see whether history will repeat or deviate. And then you look at the charts to see, which are the areas that are moving right now. I'm a big believer in momentum as well.
Okay.
What I read from James O'Shaughnessy's book, What Works on Wall Street.
Sure. So you alluded to the the history lesson of the markets and learning based on previous cycles, what's worked, what hasn't. What does the current market environment most remind you of? Is there a historical period that you think is a closest analog or closest match, or is inspiring how you're thinking about the market today, or does it feel different in some ways?
Good question. In some ways, it sort of reminds me of the late 1990s.
Sure. Okay.
Because we had a near bear market in 1998, as
Yep.
we did in 2018.
Yeah.
The Fed then reversed course, started lowering interest rates. We had what I call a double bump year.
Okay.
The old adage of as goes January, so goes the year.
Sure.
But whenever we've seen the market up in both January and then again in February, which
Right.
has happened 28 times since World War II, excluding this year, the market was up 28 of 28 times and gained a total return in excess of 24%.
Wow.
So what's happening this year is exactly the same.
Right.
And you can really blame it or congratulate it on the Fed because
Right.
of their reversing policy. So
Yeah.
there were a lot of things in the end of 2018 that hinted that 2019 was going to be a very strong year.
Interesting, and it certainly seemed to play out. What following your work for a while, I know you incorporate cycles, some things about like a presidential cycle, for example, or heading into election year, and there could be some signal there for sure. How do you reconcile what you see with seasonal tendencies or cycles and prices themselves, trends? So for example, what happens when the markets disagree or don't play along with the cycle? How do you reconcile that disagreement in your work?
Well, first off, I wrote 2 books in the mid 1990s on sector rotation through an average economic cycle.
Yep.
And then I came to the conclusion, well, gee, that's like the cart before the horse. Because if the market anticipates the economy by about 7 months, so meaning we either had a bear market or a severe correction, an average of 7 months before each of the 16 recessions since World War II,
Right.
the thought is, well, then really you should be looking at the market to try to tell you where it thinks the economy is.
Got it.
So that's the first thought. I mean, the economy can be quite helpful in terms of which sectors are likely to be leaders, laggards. But just as you have cyclical bulls and bears within secular bulls, you also have mini cycles within the broader, larger cycle. So in many ways, I don't know, I just keep thinking, is it all that important to know exactly where we are in the economic cycle? I'd rather just look at what are the sectors, sub-industries that are doing well, and try to anticipate as to whether they will likely continue to do well for an extended period.
It's really interesting, and you hit on some of the sector themes. And thinking of 2019, I think it caught some investors off guard a little bit, where it's one of those where you might have had the market call right, but you didn't get paid for it. Where the market overall was very, very strong, but you had things like utilities and real estate, performing really, really well, which surprised some people. You had small caps underperforming for much of the year when people might anticipate them outperforming.
Right.
How have you dealt in your work with some of those themes that were a little surprising, or did that line up with your approach overall? How did you think about that?
Well, right now I like to tell people that I put on some weight because I've had to eat so much crow. What I mean by that is that, yes, I thought that this was going to be an up year. And a lot of the indicators pointed to a very strong up year, but I just wasn't brave enough to embrace those indicators.
Right.
One, for instance, is that in 2018, the difference between the best and the worst performing sector within the S&P 500 was well below the average over the last 30 years. Whenever that has happened, the market, like a compressed spring, popped the year after, gaining more than 13% on average, versus looking at less than 5% in the other instances. Like I had mentioned earlier, the double bump up January and February, the market tends to rise an average of 24% on a total return basis. We've never had 2 down years in a row, except in the midst of a deep mega meltdown bear market, which we were not in. And then also realizing that the Fed was thinking about lowering interest rates. Since World War II, the market was up 10.5% 6 months after, 14% 12 months after. And what's giving me some optimism for this year is that it's typically up about 18.5% 18 months later. So through the end of 2020, provided the Fed does not start talking about raising rates, the tailwind of a easier monetary policy could be helpful toward equities.
Very, very interesting. And I saw your S&P target for next year in the 3,400s, if I remember right. Pretty solid year. So in your work, what would tell you, let's fast forward, what would happen that would tell you that that's not going to play out as you'd expect? Would it be a technical thing that price does something different than move on that trajectory? Would it be the Fed? Would it be some sort of macro or interest rates? What kind of things would you be looking for that would tell you that more of the bull case is not going to play out? This is going to be some different environment.
Well, like the old Zedgar and Evans song, my target is 34.35, implying basically a 7.3% gain off of my anticipated 3,200 close for the S&P 500. So looking at the presidential cycle, last year was the third year, which is, we all know, a very strong year, not only in terms of price change, up almost 16% on average, but also batting average. We've never had a down year. We've had 2 flat years. In the fourth year of a president's term in office, the market's up 6.3%, rises 78% of the time. But when a Republican is looking to get reelected, it's been up 100% of the time. Of course, the statistician would say, well, Sam, the observation set, is pretty low at 6. Especially if you say, but are they left-handed? But those are the questions that the media asks, so that's why I prepare the stuff.
Of course.
And then, like I mentioned about earnings, we have been seeing what I wrote an article called directionally challenged, because the market was going up in price when earnings estimates were coming down. So the thought is, well, gee, we're looking at a forward PE of 18.5 times versus the average of 16.5 over the last 20 years. But the market keeps going up. Well, prices lead fundamentals. So that implied to me that the market is anticipating an upward revision to earnings estimates as the year progresses. What's going to do that? Well, we're going to see an improvement in economic forecasts because of the easier monetary policy. I think that the president will end up signing a phase 1 accord, but then nothing's going to happen until after the election. I think he wants to waive that positive signature, shades of Neville Chamberlain maybe, indicating that we've got an agreement, but that's the easy low-hanging fruit, but we're not going to press it until after the election. I also think the president is going to indicate that we should have another tax cut, really lifting the lid on SALT. So the state and local taxes take off that overhead 10% or 10,000 level. The Democrats will probably approve it because it affects the blue states more. But then the Democrats might say, let's not give him a victory in an election year. And then he'll turn around and say, see, even your elected officials are not allowing you the tax cut that you deserve. So it's all politics in 2020. So I really don't expect a lot of new initiatives to get done. So it's going to be, how well does the economy respond to lower rates? How well do earnings respond? And if the Fed remains sitting on its hands, and then we don't have any unanticipated events, because quite frankly, they're hard to anticipate.
You mentioned the U.S.-China trade negotiation, which has obviously been a theme. In the last week, we had a couple days where the market was up or down dramatically based on rumors and tweets and all of that. Can you talk just a little bit about the environment we're at now, not just with social media, tweets and everything, but just the vast amount of information coming at investors? I mean, over your career, you've been doing this for a couple of years. How has that changed, and how has that changed your process? How have you adapted to the fact that the news cycle is so short and you have rumors like that are going to move things? Is that similar to other things you would have seen, or is this just a new paradigm that investors have to get used to?
Well, just as we used to be able to look at television commercials and see one frame for about 10 seconds and then another frame, everything seems to have been speeded up. So there is immediacy, there is impatience, and then also with the change of communications in the Fed and the government, et cetera, there's an increase in transparency.
Right.
Now, I like to say that obviously we know that fear and greed are the two emotions that move stock prices. Unfortunately, in this day and age of instant information, I can experience both fear and greed at the exact same moment. So, the problem is that I'm not alone. I mean, you've got investors who, oh my gosh, there's a potential for a tweet here. There's a potential for a signing here. What do I do? And I think more and more investors are just being frozen by indecision.
That's right. That's right. I'd love to talk a little bit about your process. Do you have and we talk a lot with our clients about investor routines and just getting in good habits as an investor, what you consume, how you go about your day. Do you have a normal process that you use to consume information, to look at charts, to look at other data, or a way that you approach your day or your week to try and be thoughtful about how you're spending your time with that?
Right. I don't know how the people who write daily can do it. I write 3 times a week, and to me, that's enough.
Right.
But every Monday, I publish a sector watch piece, which is a little bit of a deep dive into seasonality, strategy, whatever the event might be. Wednesday is our investment policy notes, sort of a summary of the main economic, fundamental, and technical considerations, as well as sector recommendations. And then on Friday, I write our lead article for our flagship publication, The Outlook. So what first off, I try to get up early and watch financial news, read the financial press, basically to see what is likely to move markets for the day. Then take a look at our MarketScope Advisor platform to see what kind of economic data will be coming out in the week ahead. And then I love to crunch numbers. And so I download the S&P indices, sectors, sub-industries, cap sizes, style, region, so forth. And just look at the charts themselves, as well as look at the what areas are leading, which ones are lagging, and also which ones are moving along the way, which ones have been moving up in terms of the momentum ranks, been moving down, et cetera. Just to get an idea of, I'm in a sense watching the smarter investors to see what are they doing. And usually momentum tends to carry forward. Like the old saying, let your winners ride, but cut your losers short. The losers have a lot of overhead resistance that they have to work through before they can become leaders once again. Yet how many people who own a stock that's hit a 52-week high are disappointed? And how many of those undisappointed people are going to brag to their friends who will then buy that stock without doing the research, et cetera?
Fair enough.
But then also I look to seasonality. Because historically we know that the strongest 6 months are November through April, weakest are May through October. I'm a big believer, however, that you should rotate, not retreat, because the market has gone up about 1.5% May through October. Annualized, that's better than cash. It's also gone up about 2 out of every 3 years. So why be in cash? So Pacer came to me and said, hey, let's come up with an ETF based on this seasonal rotation pattern, which they now have out there. The ticker is SZNE, like season. And knock on wood, but so far it's doing very well and will likely outperform the market by more than 500 basis points this year.
That's great. Congratulations. That's fantastic.
And past performance is no guarantee of future results.
Let's get that out there. So you mentioned, looking at the short term, what's going to move the market today. Your work strikes me as being thoughtfully
long-term, understanding this, how things are evolving over time and putting things into context. How do you balance the short-term noise, the short-term fluctuations, but keep anchored in the long-term appropriately? Because I think a lot of people struggle. They make long-term decisions based on short-term information. So how do you balance those two?
Well, I guess I'm aware of the short term, but I keep focusing on the longer term.
That's great.
When we come up with a price target, it is a 12-month ahead price target. So even though we are, 2 weeks away from the end of the year, I frequently will get questions, well, are you readjusting your 2019 target? No. Who cares? So constantly I'm looking at a 12-month target. The reason being that our analysts then use that as a guide, and if the intrinsic value of the stocks that they follow is higher than that, then they might give it a buy. If it's lower, then they would give it a sell. So in a sense, to have something to aim for a year down the road. But I'll look at the charts to look at strength, weakness, overbought, oversold, because obviously if you have a long-term time horizon, there are still better entry points.
Yeah. Got it. I'd love to ask a question about what I'd call the worst call question. Is there an example you can think about in your experience where a call totally went against you, where the market just completely crushed you? And what did you learn from that experience? How did you get through it? How did you improve your process afterwards?
Well, yes. I have to admit that in the spring of 2008, I did not think we would slip into a near 60% bear market.
Right.
One reason was that historically mega meltdowns or 40+% bear markets occurred about every 25 years because you needed a new generation to forget how painful it was to go through that kind of decline. Well, obviously, we had our second 40+% bear market in the 2000s. So I learned that 100-year floods are not separated by 100 years. But I also learned, I did a deep dive into what worked, what did not work in 2008, and found that diversification did not fail us. Our memories and our expectations failed us. We forgot that correlation and quantity are not the same things. By having large, mid, small, developed, emerging markets, REITs, commodities, does not make you diversified because they're all economically sensitive. What's diversified are stocks and bonds, period. Add a little gold and some heavy drinking and then you are pretty well diversified. And also the time that it takes to go from a peak to the 20% decline threshold is 9 months. And that's exactly what happened in 08. That we didn't fall into an official bear market until early July. And even though I thought that Bear Stearns' demise was the Penn Central, Drexel Burnham of this bear market, it wasn't.
Right. If for people just getting started in the industry, trying to get their head around all these types of themes that we've been talking about, what would you give them, or what would you give a younger you, a book or somewhere to prepare to try to learn more about this? Where would you point them?
Well, I am a novice coin collector, and I remember early on advice that was buy the book before you buy or sell the coin. And I think the same goes for investing. Whether it's investing for dummies to get a broad 10,000 view look as to why are you investing. It's probably for retirement. So you want to make sure you outpace inflation and taxes. And stocks are basically the best way to do that. The Intelligent Asset Allocator by William Bernstein, I think is an excellent fundamental book describing diversification as well as long-term investing. John Murphy's book on technical analysis is a good way to read the charts, etc. So just being inquisitive, but also doing your own work. I find that if I really took my own advice most of the times, I'd be more successful than I am now, rather than deferring to others or being convinced by others. So if you have a technique that you are comfortable with, stick to that, be true to your technique, realize that it's not going to work all the time, but that Murphy's Law comes into investing as well. The day you give up on a time-tested investment strategy is the day in which it'll start working all over again.
That is a perfect place to wrap up. Sam Stovall, thanks so much. This was such a pleasure to talk with you.
My pleasure. Thanks for having me, Dave.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.